Okay, great. Well, hello everyone. I can kick off now. Thank you for joining us this afternoon for our webinar. My name is Ailish, and I'm an associate analyst here at Planet Tracker. So over the next hour, we'll be exploring the hidden climate risk, methane's impact on investment returns. And I'll be kicking off the webinar examining 25 of the largest financial institutions with holdings in major meat, dairy, and rice companies, exploring how methane emissions create material risks, where portfolios are most exposed, and the actions investors should take to protect value and drive emission reductions. I'll then be passing over to Nusha, the CEO of Changing Markets Foundation, who will be discussing agriculture's accountability, companies leading methane mitigation, and then countries advancing measures to achieve the Global Methane Pledge. And we'll then hear from Giovanna, a shareholder advocate at Green Century Capital Management, who will explore how sustainable investment strategies, including shareholder advocacy, may reduce methane emissions to help investors and companies manage environmental and financial risks. So just some quick housekeeping before we start. If you have any questions, please add them to the Q&A function, as we'll have a section at the end that we can answer them. But in case we don't get back to you on the webinar, we will reply via email later on. And lastly, we will be recording this webinar. Next slide, please. So before we kick it off, I just wanted to take a minute to introduce Planet Tracker to those of you who aren't familiar with our work. So Planet Tracker is a sustainable finance think tank conducting research on nature-related risks and opportunities. You may have heard of our sister company, Carbon Tracker, who works on energy transition, and Planet Tracker is focused on biodiversity and nature. Next slide, please. So we focus on the drivers of biodiversity loss, specifically land and sea use change, exploitation of natural resources, pollution, and climate change. And we provide in-depth research reports on each of these topics, covering a range of industries and themes, as you can see on the slide here. We are not for profit, so everything we do is for the common good, and all of our research is publicly available on our website or on your usual financial data platforms. And with that being said, let's dive into the webinar. Next slide, please. So the focus of this section is examining whether investors are integrating agricultural methane into climate strategies, risk frameworks, and stewardship expectations. And everything I'll walk through today is grounded in Planet Tracker's Methane Matters report, and then the follow-up Materially Neglected report that we did in collaboration with the Changing Markets Foundation. And also feel free to scan the QR code for the report here, and we will send it after the webinar as well. Next slide, please. So the issue at hand, methane is a major greenhouse gas responsible for around 0.5 degrees of current global heating. It is roughly 80 times more potent than CO2, but persists in the atmosphere for only about a decade. And this makes methane reduction the fastest lever available to slow global heating in the near term, offering one of the highest climate returns per dollar invested. Although it is responsible for more than a third of global heating, methane received only around 2% of global climate finance in 2022, according to the Climate Policy Initiative, which estimates that a tenfold increase in annual public and private investment is needed. Yet most investors still fold methane into broad CO2 equivalent frameworks, including commitments, targets, and policies. Methane also qualifies as both a major greenhouse gas and an air pollutant, and should therefore be treated as a separate risk category with specific abatement pathways explored. The UN Environmental Programme, the 2025 Global Methane Stats Report, outlined the urgent need for action on methane and estimated that emissions are projected to rise by 5% by 2030 and 21% by 2050 from 2020 levels. If current commitments were met and all technical measures available were implemented, methane emissions could be reduced by 32% and 0.2% of, or 2.2 degrees of global warming avoided. So Methane Matters, which we published last October, analyzes methane emissions targets and implementation plans across 52 of the largest meat, dairy, and rice companies. And the key message from that report was that methane is one of the fastest climate risk levers available today, but investors can only act effectively if they understand where emissions are concentrated, how weak disclosures currently is, and why most corporate targets lack credibility. So the starting point for this analysis was a universe of 52 of the world's largest meat, dairy, and rice companies, as I've said, and mainly producers that sit at the center of global food supply chains, such as JBS, Danone, Anheuser, and Bev. And this was achieved using the FAO's Gleam 3 model and production data pulled from the company's own reports. So when we aggregated the estimated methane emissions of these 52 companies, they represent around 12% of total global agricultural methane emissions. Now, taken on its own, that number might sound modest, but we have to remember agriculture is a highly fragmented sector globally with millions of producers. So it's not surprising that even the largest companies represent a minority share of total emissions. But when we look inside those 52 companies, that's where we find extreme concentration. So the top 10 companies alone account for 68.4% of the methane emissions within the sample. So although agriculture is fragmented at the producer level, methane exposure at the corporate level is highly skewed towards a small number of firms. And this concentration becomes even more stark when we look at individual companies. So one company, JBS, accounts for 25% of total methane footprint of the entire 52 company sample. So to put that differently, a single corporate issuer is responsible for more than a quarter of the methane emissions generated by large meat, dairy, and rice companies globally. And from an asset management perspective, this is a critical insight because it tells us something very important about how methane risk will materialize in portfolios. And it has several implications. So, first, it means methane risk cannot be diversified away through broad market exposure. If you hold global food um, or agribusiness exposure through benchmarks, you are almost certainly exposed to a small number of very large methane emitters. Second, it means methane risk is engageable because exposure is concentrated. A relatively small number of engagement targets accounts for a very large share of the risk. And third, concentration changes how transition risk can reprice. So when emissions are concentrated, regulatory changes, disclosure requirements, or supply chain standards do not reprice markets smoothly. They tend to create steep changes in perceived risk for specific issuers. But if methane disclosure rules tighten, or if methane becomes explicitly regulated in line with the Global Methane Pledge, a small number of companies will suddenly face outsized compliance cost and capital expenditure requirements. And it's also important to note where this concentration comes from. So the companies dominating methane emissions are primarily meat or beef and dairy producers because ruminant livestock are responsible for the vast majority of agricultural methane emissions through enteric fermentation. And that means, or this means that methane emission or exposure is not evenly spread across the food sector. It's structurally embedded in specific protein systems, particularly beef and dairy, and to a lesser extent, rice, pork, and poultry. So when asset managers think about methane risk, the relevant question is not do we have food exposure, but rather which food companies and which protein systems. Next slide, please. So the follow-up report materially neglected agricultural methane and investor risk in collaboration with Changing Markets Foundation, analyzes methane emissions, targets, and implementation plans across 25 investors with holdings within the largest meat, dairy, and rice companies, and examining whether investors are integrating agricultural methane into climate strategies and risk frameworks. So this slide summarizes the core findings of the report. First, we found high exposure but very limited strategy. So across 25 major financial institutions, there's roughly $120 billion invested in companies linked to around 1 billion tons of methane emissions, which is a very material exposure. Yet despite that scale, 80% of institutions score below 10% on our methane risk assessment within the report. So in other words, methane risk is financially significant, but it is largely unmanaged. Second, there's a clear policy practice disconnect. So many institutions with high level climate commitments, or they have high level climate commitments, but when we look at specifically at agricultural methane, which is a major and fast acting climate driver, as we said, almost none meaningfully integrate into their climate frameworks. So only NBIM explicitly incorporates agricultural methane into its expectations, and none of the institutions assessed aligned with the Global Methane Pledge targets. So that gap between public commitments and implementation is striking. And then third, we identified a strategic capital allocation gap. So there was very limited capital flowing towards methane abatement technologies such as feed additives, alternative proteins, or improved livestock management systems. And we found no systemic investment approach to scaling these solutions. So capital remains concentrated in methane intensive value chains rather than in the technologies that it would take to reduce the risk. And then, as the chart shows, methane exposure is highly concentrated among a small number of very large asset managers, meaning that engagement and capital reallocation by a handful of players could materially shift outcomes. Overall, methane is financially material, climate critical, and currently neglected in investment practice that creates both risk and opportunity. And the risk is clear: unmanaged methane exposure increases transition risk, regulatory risk, reputational risk, particularly as policy attention intensifies and measurements improve. But the opportunity is equally significant. Methane is one of the fastest ways to slow near-term warming, and targeted capital allocation, stronger engagement, and clearer expectations could deliver rapid climate impact while positioning investors ahead of tightening policy and market shifts. Next slide, please. So based on this research, we have outlined clear expectations for financial institutions. So one was integrate methane into net zero strategies. So methane must be treated as an integral component of all net zero transition plans. And investors should require that companies set methane-specific reduction targets and pathways alongside CO2, ensuring that mitigation efforts reflect the gas's shorter atmospheric lifetime and outsized warming potential. Two, deploy active stewardship with escalation. So this is two recommendations in one. Set methane reduction targets and policies aligned with the Global Methane Pledge. So investors should align their portfolio level commitments with the objectives of the Global Methane Pledge, seeking at least a 30% reduction in methane emissions by 2030 compared to 2020 levels. Given agriculture's dominant role in global methane emissions, investors should establish quantitative time-bound specific or sector-specific targets, which should extend across the livestock value chain. This includes manure management and enteric fermentation, with performance monitored and disclosed annually, and then also adopt methane policies and frameworks. So investors should introduce dedicated policies addressing methane emissions, including explicit expectations for corporate disclosure, target setting, and mitigation across scopes 1, 2, and 3. These policies should mirror existing approaches to high emitting sectors such as energy, incorporating measurable goals, and exclusion criteria for high risk activities. And then finally, reallocate capital towards transition leaders. So investors should increase capital allocation away from high emitting livestock operations and towards low emission and diversified protein production. So by supporting innovative and resilience in the food sector, investors can mitigate portfolio exposure to transition and physical risks while contributing to global methane reduction objectives. Next slide, please. And I will now pass to Nusha.
Thank you so much, Ailish, for this excellent presentation of our joint report. So I want to start with a little bit of context that this is the second report Changing Markets Foundation did together with Planet Tracker. Our first report was launched in January 2023. It was called Hot Money, and it looked at investors, at both asset managers and the ones giving loans to the 15 of the biggest meat and dairy companies. And when we launched that report, by total coincidence, on the same day, Danone became the first company, the first food companies actually that put in place a commitment to 30% methane reductions and also to disclose its methane emissions. And that meant we did not get that much media coverage for our report, but it was really a significant move because This is the first company that put methane out of the blind spot. So we had a front runner. And then, yeah, and it's really, really important that they took this move because if you put the next slide on, please, you can see that most of emissions actually come from man-made activities, and 42% of total is now from farming, from agriculture. And as Eilish was saying, methane is responsible for around a third of warming so far, around half a degree. And it's the biggest kind of opportunity that we have because it's short-lived and very potent. If we quickly cut methane emissions, this actually buys us time, and it's the best chance we have to still stay under 1.5 or, under 2 or as close to 1.5 trajectory that countries have committed to in under the methane, under the Paris Agreement. In 2021, countries published the Global Methane Pledge. So right now we have 160 countries signed up. And the UNEP CCAC report that was published last year actually showed that we are for the first time bending the curve. So if all the commitments that the countries put in place are implemented, we will get 8% reductions by 2030. So we are bending the curve, but it's not fast enough. We need to really ramp up the actions. And actually, agriculture is again the sector where we could do this really, really quickly, and not enough actions are actually happening in place. Next slide. I wanted to more talk about companies and what companies in the sector are doing. So not so much investors, but I wanted to start with this graph because if you look at this graph, you see that dairy makes up the bulk of the total exposure, so the 120 billion that Eilish was talking about. 96 billion of these investors have invested in the six dairy companies, 16 billion in seven rice, and 8 billion in the seven meat companies. And Nestle alone accounts for 61% of this exposure. So there is quite a big concentration, and that actually makes the case for this targeted engagement with these companies. And we've also seen that there is now the situation is much better than in January 2023 because companies have started to take action. We at COP30, we even had the first meat company, Marfrig, that published a commitment. They said 33% methane reduction by 2035, and they also said they will start reporting methane separately. Next slide. We published a methane action tracker just before COP30 as well. It would be great if, Chris, you could drop that in the chat. So methane action tracker is actually looking at dairy coffee brands and retailers, but we're planning to expand also to meat and to fast food companies, and how they perform on the following categories. So for this dairy coffee brands, we're looking at methane accounting, methane reporting. We're looking whether or not they have an action plan, whether or not they have a target, and also if they have reported any reductions already. And you could see that the situation is improving. So Danone used to be a front runner. Now they're in the third place, and we have Bell Group and General Mills with 84 and 70, almost 75 points in the lead. And what these companies are doing is actually they have already started reporting reductions, they have targets, and they're disclosing their methane emissions. And this is really significant. A lot of them, you would see that green versus red tick are members of the Dairy Methane Action Alliance, which was set up in December 2023. So kind of that was a big year for for methane mitigation in the sector because yeah, a lot of commitments were made, but they're also acting on this commitment. So I would argue that it's a really good year for investors to come in and start engaging with those companies and start kind of pushing them to do more. The first four companies have already reported methane reductions. Nestle last week published its non-financial report where they said 20.1% methane has been cut from the baseline. We would have loved to see some more detail on where these emissions reductions have been achieved. So transparency around that would also be really something investors can push for, because that then gives us more kind of visibility on what other companies in the sector can do and how we can ramp up this action. And yeah, we also have companies like Starbucks that have started to become transparent about methane reductions. And for those companies, we there's also a lot they can do on shifting to plant-based, such as price parity between plant-based and dairy milks, and things like that. Next slide, please. We're also tracking retailers, so we're just working on another ranking with Mighty Earth, which will be published in April. And even here, we can see that there's variety of things that companies are doing. We have right now only one company. It's Albert Heijn, which is part of Ahold Delhaize, that has reported methane emissions separately. But we have other things that retailers are doing. One of the things I want to maybe highlight is the protein split. So a lot of companies now have maybe not a few, maybe not a lot is a bit of an overstatement, but a few companies are now aligning their protein sales or committing to align their protein sales to the planetary health diet, which is like 60% plant-based and 40% animal-based protein by 2030. So here also there's potential for investors to engage and to kind of, push these retailers to also put in place methane targets, methane reporting, and also measures to address food waste, which is another big source of methane. Next slide. The last thing I would like to highlight is that we also look at the big livestock producing countries. So the countries that have mostly signed the pledge and what they have been doing on methane emissions. We are doing an update on that in March. Right now, we see that the action is not where we would like to see it. From 16 high meat and dairy producing and consuming countries that we analyzed, as well as the EU, 82% of them have signed up to the Global Methane Pledge, but only 6 countries and the EU have reported small methane reductions. Yeah, please use this tracker to inform your work. I think also since 2023, we now have Norges, which is the first investor that is kind of saying that the companies have to align themselves with the Global Methane Pledge. So we are hoping that investors can push companies a little bit more to act on methane, because this is really an emergency brake, and food production is really uniquely dependent on the stable climatic situation. We've seen just recently there was an article in the FT that kind of highlighted how beef farmers in the UK are already impacted in 2 ways by the climate change. So they couldn't produce enough feed last year because of the droughts, and now they're kind of can't put animals in the pastures because of floods. So this kind of situation is becoming worse and worse. And if we don't act on methane, yeah, it's something that investors should realize is within their own interest to kind of, ramp up the urgency on that. So with that, I would like to hand over to Giovanna, and thank you very much. Open to questions afterwards.
Thank you so much, Nusha. To reintroduce myself, I'm Giovanna Eichner, and I'm a shareholder advocate at Green Century Capital Management. Next slide, please. Green Century is celebrating its 35th anniversary this year as one of the first families of environmentally responsible and fossil fuel-free mutual funds in the country. Our mission is to help people make an impact for the planet with their investments. And there are a number of ways that we do that. Next slide, please. The first thing we do is we offer sustainable investment portfolios through our 3 environmentally screened mutual funds, which are outlined here. Next slide, please. The second, to which I'll be speaking most to, is our shareholder advocacy program, where me and 3 other great advocates are actively working with the companies we hold to improve their corporate environmental performance. The third thing we have is our unique ownership structure. We were started by a group of environmental and public nonprofits that operate all over the country, working on issues like promoting cleaner transit options and fighting for the right to repair our stuff. As a shareholder advocate, I work directly with companies to negotiate commitments to improve their environmental policies and achieve real-world, meaningful change. So to dive a little bit more into what the shareholder advocacy process looks like, each season, our advocacy team will engage about 50 to 70 companies in dialogue on important environmental issues. Some of that is follow-up on previous engagements, but the majority of them are new dialogues on issues from climate change to forest protection to preventing plastic pollution. We come into each conversation with a set of questions about the financial risks that are associated with these important environmental issues. And we use this conversation to really assess if the company has policies in place that are adequately mitigating these risks. For example, does a company have a science-aligned climate emissions reduction target? Does it have a plan to get there? Are there policies that are ensuring that the commodities that the company sources are deforestation-free? Does the company have a plan to measure, disclose, and cut its plastic use? These are all critical questions for us. After speaking with a company, we determine if it's adequately mitigating the risks that we've raised, or perhaps maybe they'll adopt a policy that we recommend to address those risks, and that's fantastic. We'll get written confirmation and then move on. If not, we'll move on and file a shareholder proposal to bring that issue before the company's shareholders, because we feel it is important for them to vote upon. So far this season, we've met with 60 companies and filed 26 shareholder proposals. Next, after filing a proposal, we'll be able to see if we're able to withdraw it. Typically, we withdraw about half of the proposals we file in exchange for a meaningful commitment for the company to address the environmental risk that we've raised. However, this is not always the case, and typically about half of our proposals will have to go to the vote. Last season, 16 proposals were voted on by Green Century, and that was a record high. This is the approach that we follow for every company, regardless of the industry or issue area. We believe that all companies are or should be receptive to shareholder input and inquiries, and we've generally found that to be the case. In almost all cases, peer analysis is also a critical part of us doing our homework on the risks posed to the company. We also meet regularly with companies to track their progress on commitments they made to us in withdrawal agreements. If necessary, we can turn up the pressure to ensure that they have completely implemented what they committed to do. So I want to give a couple examples. Next slide, please. One of our great wins is with Costco. In 2023, Green Century filed a shareholder resolution that urged Costco to address its plastic risks and impacts. After meeting with the company several times, Costco agreed to disclose the plastic footprint of its Kirkland Signature brand and develop a comprehensive plan. In 2024, we saw Costco publish its plan that details steps it's taking to reduce plastic packaging, increasing recycling content in its packaging, and transitioning packaging to that is more easily recyclable. We also see the importance of following up as a key part of our shareholder advocacy strategy. Following commitments with Green Century, 3 major companies recently published plans sharing how they will hit their climate targets. These plans were published after multiple dialogues. Following the initial commitments, we were able to guide the construction of the plan. Semiconductor superpowers, Intel and Advanced Micro Devices, for example, published their plans to cut the emissions of manufacturing and use of their products, which is over 90% of their overall climate footprint. AGCO, which is one of the largest farm equipment manufacturers in the world, also released a climate roadmap that outlines new renewable energy projects that may reduce emissions equivalent to taking more than 23,000 cars off the road each year. So shareholder advocacy can have a real impact. So now I want to talk about, of course, methane while we're here today. And I want to talk a little bit about why Green Century decided to engage the companies that it holds on their methane emissions. And of course, the key reason for this is we saw the problem that Ailish and Nasha highlighted. Companies, investors, and the planet face financial and systemic risks from climate change, and methane is 80 times more potent than carbon dioxide. Even more, the agricultural companies that pump the most methane into the atmosphere are those that are most vulnerable to its climate warming consequences. This includes heat waves, droughts, and storms that will harm their bottom lines. Nevertheless, as the report highlights, the largest emitters are failing to even mention methane in their sustainability reporting or climate strategies. Even though we saw this monumental problem, we also saw a clear solution. Companies that measure their methane emissions and create plans to reduce them will more quickly cut warming in the short term, addressing the risks of a changing climate more effectively and efficiently. With this in mind, we set the goal to have major methane emitters in our funds publicly disclose their methane emissions, which we believe is the first step in creating plans to reduce them. To do this, we started with companies that have large methane footprints from beef, as well as bold climate targets to reduce them. Yet these companies also lack public plans demonstrating that they will achieve the reductions that they've set out to make. This included McDonald's and Wendy's, which both have near-term targets that include beef-associated emissions. Nevertheless, as investors, we continue to see that greenhouse gases from beef have continued to grow at these companies. Greenhouse gases from beef have also been estimated to account for nearly 1/3 of McDonald's total greenhouse gas footprint in 2024 and over half of Wendy's. By highlighting the reputational, competitive, and financial risks of companies failing to meet their climate ambitions, we sought to demonstrate that it is in the best interest of these companies to tackle methane reductions in particular as proof of an effective and efficient climate strategy. There's also a great sense of urgency. We see the demand for animal proteins is continuing to increase, and deadlines for these companies' targets loom. With this, addressing methane is more critical than ever to reach goals and mitigate climate-related risk. So we filed shareholder proposals at McDonald's and Wendy's, asking that they assess if their current climate actions are sufficient to achieve their emissions reductions targets. Both proposals received a high enough share of the shareholder vote to refile next year. More importantly, both proposals allowed us to engage in meaningful dialogue with companies on how they can better report emissions data and reduction plans. And we saw that in 2025, Wendy's enhanced its climate disclosures to include commodity-specific emissions disclosures, particularly from beef. So how did we push for this change? A key part of shareholder advocacy is looking not just at the environmental impacts, but the financial risks that companies face. Disclosing methane emissions and outlining meaningful plans to address them will add credibility to climate commitments and mitigate several key risks at companies that also affect investor portfolios. Of course, there's a climate risk. As climate change intensifies, so do the weather patterns that accelerate crop failure and reduce agricultural and livestock productivity. As a result, agricultural products that these companies rely on will face both variability and price volatility. Climate change is the largest nature loss driver for the food sector, and it is estimated to cost over $163 billion per year globally by 2030 if no action is taken. There's also a deep competitive risk. Peers that demonstrate more climate ambition in their disclosures and policies may have an advantage over laggards as consumers are more aware of the climate impact of their food, and we see this particularly in Europe. In 2025, though, a Deloitte survey found that across the globe, most respondents report changing their personal behaviors to help address climate change. Burger King, owned by Restaurant Brands International, has long offered the Impossible Whopper, their plant-based option, and alternative proteins generate up to 90% fewer greenhouse gas emissions than beef per quarter pound. Even more, Burger King emphasizes its focus on reducing methane emissions in its sustainability reporting, unlike its major American peers in the industry. There's also meaningful legal risks that companies face. Companies face this risk when their sustainability commitments are not supported with the credible plans to achieve them. Without addressing the largest sources of their greenhouse gas footprint, in this case, beef, companies may face claims that their climate commitments are misleading consumers. And we've seen this to be the case. Both JBS, the world's largest protein producer, and Tyson were sued in 2024 for making unsubstantiated claims about their emissions reduction goals. Particularly, the cases noted that both companies had failed to take concrete steps towards the goal's achievement and are therefore misleading consumers. Both cases were also settled with the companies having to pay large payouts. JBS's $1 billion settlement will support programs to help New York farmers reduce their greenhouse gas emissions. Finally, there's a reputational risk that we pose to companies. Quick service restaurants are unique in where they sit in the supply chain and that they're dependent on consumers' positive images of them. Hence slogans like "I'm loving it" and colorful mascots. Companies that don't follow through on their sustainability commitments may risk negative customer sentiment, and many quick service restaurants have already received negative press for their emissions heading in the wrong direction. A New York Times review of climate disclosures in 2023 for 20 of the world's largest food and restaurant companies found that more than half have not made any progress on their emissions reduction goals or have reported rising emissions levels. So, looking forward, this year we've continued the strategy of engaging large methane emitters that failed to report meaningful progress to address their climate impact. We negotiated commitments from Tyson and Jack in the Box to enhance their sustainability reporting, following back walkbacks in their disclosures. Jack in the Box, for example, has recently established targets to reduce its greenhouse gas emissions by 2028, which is a great step. Yet we noted that its first and only sustainability report from 2023 failed to outline the steps that it will take to achieve its goals. After a series of dialogues with Green Century, we were able to have Jack in the Box pledge to outline steps it will take to reach its climate commitments, publish updated sustainability data, and share a goal to release a new sustainability report in 2026. Moving into the next season of shareholder advocacy, we plan to continue engaging companies we hold on their methane emissions disclosures, action plans, and progress. We plan to scale up our campaign by partnering with others investors who see the risk that methane emissions pose to these companies and our portfolios. We are also pursuing dialogues with leaders in the space that were previously mentioned, such as Danone, and to encourage collaboration and sharing of best practices among companies. So be sure to keep up with the work that Green Century is doing by visiting our website and also viewing our most recent Winter 2026 shareholder advocacy highlights that were shared below. I really want to thank both Ailish and Nusha for contributing great data to our engagements and you all for listening to me speak today. So with that, I will hand it back to Ailish.
Thank you so much, Giovanna. And thank you both for speaking to the topic. It was a great presentation. So that moves us into the Q&A portion of our webinar, and we've had some questions come through throughout the webinar. One that has come through is what are the most promising methane abatement technologies available today? And why aren't they being adopted faster? Nusha, I can pass this one to you if you're happy to answer this one.
Yes, absolutely. I mean, we have quite a few technologies now already available, and some of them are not that high tech. So already changing the feed in a conventional way can cut emissions. Then we have feed additives, of course, and we did a big review of feed additives, and we found some are, they always lumped together as one category, but some are more proven than others. Some have been already authorized by public authorities for use and have led to reductions, for example, like Bovar, and others are still kind of in the pipeline and, have potential issues like seaweed, feed additives that are always hyped, might have potential toxicity issues that have not yet been addressed. But yeah, there's also manure management measures, which again, some are quite low tech, others are more significant. And then, of course, we also have other measures which are kind of linked with product reformulation, alternative protein, and how much emphasis companies want to give to those. And we have companies like fast food brands that Giovanna was mentioning, which could, offer alternative products, alternative meals made out of, Impossible Whopper, for example. And we also have companies like Starbucks, Costa, etc., that could offer plant-based milks as a default, or they could offer price parity. Often consumers have to pay a premium for plant-based milks. And kind of integrate those alternative protein or plant-based proteins as part of their climate strategies. Often we see the two quite divorced from each other. We have technical measures and things like regenerative agriculture that are, more prominently featured in climate strategies, and alternative protein is something that is considered, it's a separate market segment that we will grow if there is consumer demand. But actually, this can bring companies quite big reductions. Nestle's recent report showed that 6% reductions were achieved via reformulation. And yeah, it would be great if, more companies had those kind of, integration of both of these measures in their climate plans, but also more transparency on how much they're investing and what kind of emissions reductions they're expecting to come from those measures.
Perfect. Thank you so much. We've had another one that's come in, and it says in your dialogue with, or in your dialogues with company, why are they hesitant to commit to disclosing or taking action to reduce methane emissions? I can give this one to you, Giovanna, if that suits.
Yes, thank you. Happy to answer that one. So it really depends on the company. And the first thing we'll always note is that this is already data that the company likely has on hand. We see that the majority of companies nowadays, particularly in the agricultural space, utilize the greenhouse gas protocol to measure and disclose their CO2 emissions equivalent or greenhouse gas protocol guidance in order to do this. And part of that is measuring each individual emission type. So that includes methane. And so it really does become a key question for us. And the answer, as I said, varies. I believe in some cases it is that worry that once companies are publishing this data, they'll be held more accountable to actually reducing it and taking the steps that we want them to take. And so that is why the ask is so important in the first place. But then there's also, I believe, a little bit of concern around the quality of the data. Sometimes, depending on where the company sits in the supply chain, it can be more difficult to get that data. And so we understand that. But again, as investors, we believe that the methane footprint of a company, particularly in the agricultural space, just helps assess where they're at in terms of their emissions reduction progress and demonstrates that they're working at, again, the most efficient rate to really reach their climate targets, given, again, as Yusha was saying, the impact that methane can have on decreasing warming.
Perfect. Thank you so much. We've had another one come in that says, what does it take to integrate methane into climate frameworks for a corporate or portfolio? Do companies use short-term metrics like GWP to prioritize immediate abatement solutions? And I can take this one, but please jump in if you have anything to add. And I think to meaningfully integrate methane into a corporate or portfolio climate framework, the first step is recognizing that methane is not just another ton of CO2 equivalent. Methane behaves differently. It's short-lived, but extremely potent, especially within the first 20 years. And that's what we've gone through within this webinar. And that means that driving near-term warming and near-term transition risk in a way that is long-lived CO2 and that CO2 does not. So practically, I think integration requires three things. I think first, methane needs to be treated as a standalone risk in category. So most climate frameworks aggregate everything into CO2 equivalent using a 100-year metric, and that tends to dilute methane significance. And companies, investors need to track methane separately and set specific methane targets and assess exposure to sector and supply chain level. I think metrics matter. It was mentioned about global warming potential, and I think the 20-year global warming potential better reflects methane's short-term climate impact. But in theory, using GWP 20 should um, prioritize faster abatement. But in practice, most companies use GWP 100 because that's what reporting standards and many net zero frameworks are built upon. So while short-term metrics exist, they're not yet consistently driving capital allocation decisions. And then finally, I think capital allocation has to follow as well. I think integration isn't just about measurement, it's about financing solutions. And that includes supporting feed additives, manure management improvements, like Nusha said in her question, and engaging companies that lack credible scaling plans. So that would be my answer to that one.
Great. Yeah, if I may add, I think
Mhm.
we were quite disappointed to see the greenhouse gas protocol draft finalized earlier this year when companies now have to report scope 1 and 2 emissions as methane, but scope 3 emissions, it's okay to be CO2 equivalent. And same for nitrous oxide. And it just seems like such a missed opportunity because then this is, yeah, scope 3 is where majority of methane will occur. And it's kind of, yeah, it will require now more effort, from the side of advocacy organizations like us to push companies to actually start reporting methane as methane. And yeah, I totally agree with you that metrics are important. We also see a massive push for GWP star. I forgot to mention that in our analysis of country action, New Zealand was the only country that had methane reduction target that was kind of borderline ambition to align with what they need for 1.5, but they recently weakened the target just before COP30 because they were convinced that it's just enough to do for no additional warming approach. And this is a huge problem because that's another way to flip this argument around, right? If you keep your livestock herd constant, you're not contributing to additional warming, but actually that is not enough. We need to cut 30%, 45%. The more you reduce methane, the better it is. And it also kind of grandfathers high levels of emissions in livestock producing countries, which should be reducing this also for other reasons, right? For nature, for biodiversity, for health reasons. And yeah, this is the kind of things like methane reductions really give you triple wins. It's actually for climate, but also biodiversity. It's also air pollution because ozone is a huge, methane is a precursor of ground level ozone, which is a massive air pollutant that is still being overlooked. And it also impacts crop losses, which is, again, a financial risk.
That's great. Thank you so much, Nisha. Um, we've had another one come in that says, for those of us who are individual investors, what specific actions can we take? Giovanna, I can pass this one to you if that works.
Yeah, so I think that's a great question. And I think part of that is looking at what the different investment tools and strategies that you're using individually, what they're doing. So for us, that would be looking at, for example, our shareholder advocacy program and seeing the outcomes of the engagements that we're doing and making sure that the work of whatever organization you're invested in is truly measurable and driving progress. And so beyond, as I mentioned, Green Century also has funds that are environmentally screened. And so you can assess your own funds methane exposure through that and seeing which companies that they're invested in, of course. But a huge reason that we hold these emitters like McDonald's and Wendy's is so we're able to push for measurable and actionable changes at these companies that need to happen as investors. And so, in the absence of not investing in those companies or divesting from those companies, perhaps see what types of shareholder engagement that you are funding through your investments and ensure that it's actually meaningful. And so for Green Century, we publish reports regularly on our website that you're welcome to view about our wins and that really work to quantify the impact that we're having through our shareholder advocacy.
Perfect. Thank you so much, Giovanna. Another question that's come in is what part of rice production contributes the most to methane emissions? And I'm happy to take this one. So we focused on rice companies within our report, Methane Matters, and the vast majority, as well as dairy and meat companies, but the vast majority of methane emissions from rice production comes from continuously flooded rice paddies. So when fields are kept underwater for long periods of time, the soil becomes oxygen free, and that's what we call anaerobic conditions. So it's not the milling, transport, or fertilizer use that drives most methane. Methane is water management during cultivation. Uh, and continuous flooding is the single biggest driver. And we talked to that within the report that the biggest mitigation solution for rice is alternative wetting and drying, etc. But that will be included in the chat function if you want to take a look at that. I think that is the majority of the questions that have come in. So we will call it there. Thank you so much for everyone for joining, and thank you to my two panelists for speaking today. It was a really great to hear everything that you're doing. We will close out this webinar, but I'll give it a minute or two. So if anyone is typing questions, they can come in, and then if they come in within that space of time, we'll answer in an email. But thank you so much to everyone for joining.
Thanks for having us and thanks for organizing.
Yes, thank you very much.
Bye.
Bye.